Welcome to this explainer. Look, today we're going to do something incredibly practical. We're taking really dense academic economic policy and translating it directly into the everyday realities of your wallet. Because whether you're trying to buy a house, save for the future, or honestly just make sense of the news, there is this one invisible force out there that is completely shaping your options.
Think about it for a second. The absolute most powerful institution controlling your personal finances. Well, it's actually not the bank holding your checking account, even though that's the app you log into every single day.
It's not the companies signing your paychecks either. They don't have the final say. And, surprisingly, it's not even the stock market, despite all those constant ticker symbols flashing across our screens.
Okay, let's just dive right into this. The real puppet master behind your financial life is actually a group of just 12 people in Washington. Seriously, 12 people. They meet exactly 8 times a year to vote on a single, solitary number. And it's that one number that quietly dictates your entire financial life, from what your savings earn at the bank all the way to what your mortgage costs. Section 1. The most powerful number. Let's demystify the Fed.
So most of us have this kind of vague, lingering sense that the Federal Reserve matters, right? But let's be totally honest here. Their communication is famously intimidating. You turn on the financial news, and you just constantly hear these incredibly dense academic phrases. Things like quantitative tightening, or the neutral rate, or data dependent. And they get repeated on an endless loop without any real grounded explanation of what they actually mean for your everyday bank account. It honestly feels like they're speaking a completely different language sometimes.
So let's translate that jargon into a reality that we all understand. Think of the economy as a massive car engine. When inflation ran incredibly hot recently, rising at the fastest pace we've seen since the 1980s, that engine was severely overheating. So the Fed's primary tool to fix that wasn't some complex magic trick, it was simply hitting the brakes. By making borrowing more expensive, they forced businesses to hire less and consumers to spend a little less. Less fuel means a cooler engine. Simple as that.
And the trajectory of all this is incredibly clear. They slammed on those brakes aggressively, taking rates from near zero back in early 2022 all the way up to over 5% by mid-2023. That is record speed. But now, as we head into 2026, the inflation fever has finally broken, and they've definitively entered this cautious cutting phase. They are finally easing their foot off the brake.
Section 2. Your cash and savings. The ripple effect. So, with that really intense hiking cycle over, the big question on everyone's mind is what this new cutting phase means for your actual, physical cash. It's a direct ripple effect. Imagine dropping a heavy stone into a pond. When the Fed's benchmark rate drops, that's our stone, the ripples immediately spread outward. Directionally, those amazing 4 to 5% yields you were totally loving on your high-yield savings accounts, yeah, they're going to come down right alongside it. It might not happen the literal next day, but the gravity of those Fed cuts is going to pull your savings rates down. Now, the crucial takeaway here is not to panic, but you do need to be highly intentional with your strategy right now. You absolutely still want to keep your short-term emergency cash, the money you might actually need in the next 6 to 12 months, perfectly safe in those high-yield accounts. But you really have to recognize this. Any long-term cash you just leave sitting around is going to slowly lose its purchasing power. Because as interest rates decline, your return shrinks, but inflation is still out there, quietly eating away at what those dollars can actually buy you at the grocery store.
Section 3. The bond market math. The teeter-totter.
Okay, let's pivot and look at bonds. This is a place where a lot of fairly cautious investors got completely crushed recently. But ironically, it's also where a massive opportunity is currently shifting. It's a pure, mathematical, inverse relationship. Think of a playground teeter-totter. When the Fed raised rates heavily on one side, older bond prices on the exact opposite side crashed to the ground, dropping 10 to 20%. But as rates fall today, existing bond prices mathematically rise up into the air. If you hold a bond paying 5% and all the brand new ones being issued only pay 3%, well, suddenly your bond is the most popular kid on the playground. And this mathematical flip is a big deal. It means that for someone building a portfolio right now, intermediate-term bonds are incredibly attractive. You're locking in a solid yield, plus getting the very real potential for price increases. For the first time since 2021, the wind isn't just blowing straight in your face anymore. It's a powerful tailwind pushing your bond investments forward. Section 4. Mortgages and your home. The market freeze and thaw. The third massive area this all lands directly in your life is housing. While mortgage rates don't mirror the Fed exactly, they certainly rhyme with Fed policy and general inflation expectations. When the hiking cycle peaked, mortgage rates basically skyrocketed. They nearly tripled from their historic pandemic-era lows, hitting 7 or even 8%. And this effectively put the entire housing market into a deep freeze. Why? Well, because nobody in their right mind wanted to sell their house, give up their ultra-cheap 2 or 3% mortgage, just to buy a new place at double the borrowing cost.
But now, the thaw is beginning. And honestly, it creates a very real buyer's dilemma. If you've been sitting on the sidelines waiting for the quote-unquote perfect moment, the calculus is pretty tricky. Yes, the Fed's cutting path means mortgage rates definitely have room to decline. But remember this, lower rates act like a giant magnet. They bring a flood of buyers right back into the market. And what happens when demand goes up? It pushes the actual sticker price of the house up. So you might end up getting a lower interest rate, but paying a much higher price for the home itself. You just have to make your decision with clear eyes rather than waiting indefinitely for some magical, perfect scenario that might never happen.
Section 5. Driving in the rear view. The lag effect. Here is the part that almost nobody talks about when they explain Fed policy, but it fundamentally changes how you should view absolutely everything we just covered. The Fed is essentially trying to steer a massive, heavy cargo ship, while exclusively looking in the rearview mirror. Crazy, right? When they change a rate today, the full economic effect on hiring, consumer spending, and business investment doesn't actually hit the real world until an estimated 12 to 18 months later. By the time the data proves a rate cut is actually working, the economy is already dealing with whatever the next big problem is.
Because of this massive lag effect, the most sophisticated investors out there don't even try to day trade around exact Fed decisions. It's just impossible to perfectly time. Instead, they just step outside, check the weather, and identify whether the policy wind is at their back or blowing right in their face. Once they know that, they simply step their sails and stay patient.
Right now, that wind is definitively shifting. We are moving into a direction that deeply rewards savers who are smart enough to move their money beyond pure cash. It rewards investors who are willing to own quality bonds, and it opens up doors for borrowers who have been patiently waiting out the housing freeze. The environment today has fundamentally changed from just 2 years ago. Ultimately, understanding this whole explainer isn't about perfectly predicting the future. No one can do that. It's simply about not being the very last person to notice what has already changed in the economy right around you. The era of aggressive rate hikes is over. The era of cuts has officially begun. So my final question to you is this. The wind has already changed. Are your sails adjusted?